Good afternoon, everyone. Uh, Thanks to the organizers for a warm welcome, introduction, and giving me this opportunity. So we'll get started. I think the slides should come up. You know, when the organizers first spoke to me to say we will need the topic to be international tax planning, and then MLI, GAAR, uh, Pillar 2, etc. What I thought I'll start with is really give a context, give a background of where we are on international tax planning. Is it really a option available today? What has changed over the last 20 years that I have been in practice in this area? And why are these three terms, MLI, GAAR, etc., important? And are they actually tools for planning, or are they actually tools which give you a boundary within which you can today plan? What has changed in international tax, and particularly international tax planning over the last few years is, in my view, one single thing. And that is the cornerstone, that is really the most important aspect that you would look at when you are looking at international tax or any tax planning at this point. Because when I got into the profession many years back, it was very clear that so long as you can plan your affairs within what is permitted in the four corners of the law, what the act permits, what the law and the treaty permits, you are good, and that is something that you will be able to do. Therefore, what you went by, if I could use that term, was the letter of law, to say that once you're within the letter of law, then you're good. If you wanted to use the Mauritius Treaty, you use the Mauritius Treaty. So if there's a company in US who wants to invest in India, they set up a subsidiary in Mauritius, the Mauritius company invests in India, and when you sell the shares of the Indian company, because the India-Mauritius Treaty does not tax capital gains tax in India, you're good. And our courts also upheld that view. Courts over time globally said, as long as you are within what is permitted in law, you're good. But what's today happened over the last few years in particular is that there is a concept of morality that has crept into taxes. If you ask me personally, is morality an aspect in tax? I don't think so. Because tax, especially as we are trained, when we are trained as chartered accountants, we are told that what is paramount is the law. And therefore, if the law permits you to do something or not do something, you do that, and you don't really apply morals over it. But unfortunately, where we have moved today, and it's something what even globally has happened, and I've just put 3 tweets here for a particular reason. And you're talking of the 2 largest economies, 2 very strong economies, people who are told to be the leaders of the world, saying that we will make corporations pay their fair share of tax. Please note the fair share of tax. We will start getting large corporations to begin to pay the fair share of tax. The UK Prime Minister says that the G7 is collaborating to ensure that companies pay their fair share of tax. So what's a fair share of tax? What do I get to what is fair? Where is fairness? If the law requires me to pay tax at a particular rate and I pay that, where's the question of fairness coming in? Why should I be looking at what is a fair thing to do? So is there a moral rate of tax? I have seen that in practice, especially global MNCs. It's crept into India as well. There are tax transparency reports being issued. There are reports that civil society is doing. And those of you who are interested in this aspect, and this is something that's fascinated me, and I've been focusing on this a bit in the last few years, there's an organization in the UK which issues what's called a fair tax mark. It's almost like our ISI mark. So they give you a fair tax mark, which is to say that there is fairness in your taxation. There's fairness in the way you've arranged your affairs. So the way it works is you as a global corporation apply to them to say that this is my transfer pricing structure, this is my ownership structure, this is my tax over the last few years, and they give you a fair tax mark. And why is that important? Because over the last few years, what has also happened is that civil society has gotten, we are seeing more and more tax news in the headlines for reasons that are not really legal interpretation of the tax issues. What happened over probably 8-10 years back is that, and I'm just taking this example because it's in the public domain and it's a name that's there everywhere, is that Starbucks had a major issue in UK. What happened was Starbucks global CEO and chairman to the shareholders said that we are doing well in UK, our UK operations are doing well, and therefore we are investing more in UK and we expect to see growth in UK. And this was to shareholders of Starbucks in the US. When the HMRC, which is the department which administers taxes in the UK, His Majesty's Revenue and Customs, HMRC, reviewed Starbucks UK's income tax return and filings, they actually saw a loss. And there was no tax paid by Starbucks in UK. So they came back to say, what's happening here? Because the global chairman and the shareholders letter says that UK operations are doing well, we are having good traction, we'll be expanding, but there's a loss here and they have not paid taxes. What really was happening when they examined was that they were transfer pricing structures, they were transfer pricing agreements that were put in place to say that, and I'm oversimplifying this, that if a Starbucks store in the UK is making a cappuccino, it would be buying the beans from a related party in Switzerland, which would have decided where to buy the beans from. It would pay a royalty for knowing how to make the cappuccino. The UK operations would be funded by a loan from some related party. Therefore, there would be a lot of expenses, a lot of payments between group companies resulting in a profit which is understated, so to say, in the UK, but globally they would be making profits. And all of this was because the transfer pricing regulation said as long as you pay arm's length, you're good, and therefore you don't need to pay any more taxes. Were they right in law? 100%. Were they in compliance with all the transfer pricing rules? Yes. Could the HMRC do anything about it? No. But what happened on the ground? Of course, there's a bit of politics, like there is in everything these days. There was protests on the ground. People stopped going to Starbucks. Starbucks paid £10 million in just good faith as taxes. There were no profits. There was nothing that was due under law. But they said, we want to buy peace. We don't want to lose business. Therefore, we're making this payment. Why did we get here? I think there is things on both sides. Like I put in the first bullet here, there was undoubtedly aggressive tax planning by multinational corporations, which really didn't look good on paper. So therefore, were they on the right side of the letter of law? Yes. But were they on the right side of spirit of law? Probably not. Therefore, that was one reason. The second reason, given a lot of things that we went through in the last few years, probably the last decade after the global crisis, after Lehman, etc., there was pressure on revenues on governments across. Everybody felt that there is inadequacy in the current laws or the treaty provisions to deal with these new business models, new way things are done. You could have an Uber operating in India without a presence. And for those of you who have noticed, when you take a Uber ride, it's changed in the last 2 years, but much before that, your credit card payments would be to a Netherlands company. It said Uber BV or Uber NV. Because you had situations where you could do business in a country without ever setting foot, without even having a presence. Therefore, you were exploiting the markets, but you didn't have a presence. Therefore, globally, governments believed that the current laws are not adequate to deal with the new business models. You could put a software on a cloud and you could download and pay Microsoft, from here. Microsoft said, I don't have a permanent establishment in India, therefore I would not be paying taxes in India. Permanent establishment as a concept was really central to how international tax worked a few years back. Because what it did was it linked to physical nexus. It said if you have an office in the country, if you have a branch in the country, if you have an agent in the country, or if you have people who are working, that's when you will have a permanent establishment. And once you have a permanent establishment, you have a taxability. But today we are faced with situations where none of these can be there. You need not have an office, you need not have a branch, you need not have employees, and you need not have agents in India. But you can still earn from market in India. So there was a clear need for the laws to change, the political backdrop, like I discussed. Civil societies came in, like you had the fair tax mark. You can look up certain other organizations in the US which have released reports which run into 50 and 80 pages, putting out the tax structures that Google used, that Starbucks used, that Apple uses, with only publicly available data to say this is how they are paying taxes and this is how much they are saving taxes, or this is how much they are avoiding taxes, though that's a strong word according to me. This led to a unanimity among all countries to say that we have to tackle these large-scale taxation problems. And this is where, in my view, international tax changed completely. And I don't think it's the same that it was many years back, that it was a few years back as well. So today, in this situation, can you look at planning? You possibly could, but you can't look at planning without knowing some of the things which are being introduced to actually discourage planning. And that's what I'm going to cover in the next probably hour or so, on the 4-5 things that we need to look at, we need to be aware of while we are looking at international tax structures, while we are looking at international tax planning. What is another important thing that I have noticed in practice over the last few years is that large corporations, and I include Indian multinationals here, are not as enthusiastic and as keen on planning and reducing their taxes as they were a few years back. It's clear, it's very, very clear. I don't see the need, I don't see companies discuss fancy structures, options, restructuring, etc., to save some taxes. Two things have changed. One, there is a reputational damage. There is tax issues which are today coming and discussed in people who don't understand taxes. So it's not the group of people sitting in this room, it's not us qualified chartered accountants, but probably people at home, our parents who've done nothing to do with accounts or taxes are talking about how companies are not paying tax, etc., because that's really where things have moved. So companies don't want to get down to that situation where their tax affairs or the fact that they have avoided taxes is being discussed. Second is, globally there's a reduction in the headline tax rate. We've seen that in India as well. We are no longer a country which taxes corporations at 40%, 37%, 36%, which is where it was even 6, 8, 9 years back. Today we are looking at corporations paying taxes, companies paying taxes at 25% or even lesser in certain cases. There's no minimum alternate tax, which was one of the things that was introduced to avoid companies from planning and having profits to distribute for shareholders but not for taxes. Today you have a regime where you don't even need to get into MAT because you have a better rate of tax. So if today even companies plan and reduce their taxes, they would probably come down from a 25% rate to a 12, 13, 14, whatever percent, as against earlier they would fall from a 36, 38 to 12 or 13. So the incentive to reduce taxes or plan taxes has also reduced a bit. Same thing in the US. US companies now pay tax at 21% at the most, after Trump did the last round of reduction. It is an issue in the current elections in the US, if you have noticed. While Joe Biden has been saying that we'll make the companies pay fair share of taxes, Trump recently said if he does come back, he may even give one more round of tax reductions. So if there is a reduction in the headline rate, the incentive to save taxes is also reduced. So we are in a situation where the governments are frowning upon any kind of planning. Corporations are wary of planning because of reputation, and the incentive to plan has also reduced. It is really in all of these situations and contexts that the OECD and a group of countries initially started what's called a base erosion profit shifting project, which is today approved, accepted, being implemented by about 140 countries, including India. All of these were countries said we have to do things to plug gaps which companies are using, misusing to avoid tax. Anything that's being done to plan and strategize, to shift profits to locations where there's no activity. We will stop all of this. And OECD clearly said that this is aimed at ensuring that MNCs don't plan their affairs, don't plan their taxes, don't do anything only for the purpose of tax planning. Like I said a while back, we could, in the early 2000s also, advise a US company you are wanting to invest in India, please set up a subsidiary in Mauritius and fund the Mauritius company and buy the shares and good, you no capital gains tax. Today, can you do that? Clearly not. And that's what the BEPS project was aimed at and has achieved. So what the BEPS project did is they identified areas and they said these are 15 action points to be taken to ensure that MNCs don't misuse tax rules and don't avoid taxes and don't plan their affairs in such a way that reducing tax is the only thing that they're doing all this for. One of the first things that they did, and these are the 15 action plans that they had, they identified that harmful tax practices are there. You should discourage countries from having harmful tax practices. If you see on transparency, so there were 3 broad pillars, and if you see transparency, they looked at disclosing all the tax planning arrangements which are there. 1 and 15 were important action plans which are at the bottom. One is address tax challenges of digital economy, which is, like I discussed a while back, Uber, Airbnb, etc., which were operating in a country with minimal or no physical presence. They said, how do we address that? And they also said, we'll develop a multilateral instrument for amending bilateral treaties. This is something I'm going to discuss over the next 15-20 minutes. I think is one of the most important aspects for anybody today dealing with taxes to know, whether you are practicing or whether you are in the industry advising your companies what needs to be done and you're taking these decisions. One thing that was very clear when BEPS happened, countries met, was that the current tax treaties need an amendment. If there's physical presence, if there are companies which are splitting projects, so you always had these EPC projects where Indian companies would pay a few thousand crores, for example, to install a power line or a power plant or any of those things. Global companies would say, I will split this into, one is supply, which I'll supply from overseas, therefore I'm doing it from overseas, nothing is taxable. The other is local supplies, which don't become taxable, and local services, and they would say only a portion of it would be taxable. This was often referred to as fragmenting a project, etc. All this was possible because of how the treaties were. The treaties did not insist on substance, so if you came in through Mauritius as a US company, you would still get the benefit. So it was very clear that you had to amend the treaties. Now, how do you amend the treaties? India today has 90 plus treaties with countries. Each treaty negotiation is a exercise which goes on for years and years, sometimes decades. Our Mauritius treaty negotiation was more than 10 years. Our Singapore treaty negotiation went on for whatever to amend. Imagine amending 3,000 bilateral treaties, because that's the number of treaties that they were dealing with. If India has X number of treaties and Germany has X and US has Y, all of those bilateral treaties have to be amended, and every single bilateral treaty amendment requires a bilateral negotiation. So they came up with what's called the multilateral instrument for amending the treaties. That's the first aspect we'll discuss. Then we'll discuss GAAR and then few other things. So the multilateral instrument is the solution to amend all treaties in one go rather than amending 3,000 treaties by engaging in different negotiations. Like I said, this was decided, and then MLIs came roughly about 5 years back. What do? They deal with preventing treaty abuse mainly. They deal with artificially avoiding permanent establishment. They deal with dispute resolution, and they also deal with hybrid mismatches. Hybrid mismatches are things where you could color interest as capital gains and things like that. I'm, again, oversimplifying it, but that's not the only thing that's there in hybrid mismatches. These were the things that were sought to be avoided. Sought to be addressed. Now, artificial avoidance of PE, one I told you about artificial fragmentation of contracts. The other one was really the agency PE, where the permanent establishment clause clearly said if you have an agent who has an authority to conclude contracts, then that agent would become a permanent establishment. So companies would say that I have an agent, but he has no authority to conclude contracts. Contractually, there is no authority. He or she does not conclude. The company has no right to bind me. Therefore, there's no permanent establishment, and the company used to do everything that an agent could do. So how have they addressed it in MLI? The MLI amends only that clause to say you don't need to have authority, but as long as you are playing habitually playing a principal role in conclusion of contracts, you will become a permanent establishment. That's just one example. But you couldn't have amended 3,000 treaties, so they did this. So the reason one was speed, like I said, avoids the need to bilaterally renegotiate over 3,000 treaties. Consistency, because it's the same language across all treaties now. The OECD itself has issued explanatory notes how to interpret some of the MLI clauses. Flexibility, and I'll get to how they have achieved flexibility, because countries can choose some things that they apply, some things they don't. And then transparency, because of the explanatory statements and toolkits that are there. There's a separate page on the OECD website which gives you all these tools, which gives you all these explanatory notes, all the MLI thing. So how does MLI work? MLI, the multilateral instrument, is a common instrument which has to be signed by countries. The first thing that you will have to check today is, have both the countries signed MLI? So India has signed the MLI, and say Germany has signed the MLI. That's your first test. The second is really, has the MLI entered into force? And all of these data is available on the OECD website. If it is entered into force, what you need to see is which country has opted as covered agreement. So India signed the MLI and said, my MLI will apply to these covered countries. So India has applied it to all countries. Therefore, you will see that first. Then when Germany has signed the MLI, have they covered the India treaty? If yes, then your MLI amends the India-Germany treaty as it stands today. These are the 3 steps. It is actually simple, which is to see whether both countries have covered the other country. You will have a situation like Mauritius, where Mauritius has signed MLI, India has signed MLI, but Mauritius has not covered the India agreement. Or you will have situations like US, where India has signed the MLI, US has not signed the MLI. So India-US treaty does not get amended. India-Germany is an example, India-France is an example where both countries have signed, both countries have covered the other country. So that amends the treaty first. So today, you no longer pick up the treaty like we used to pick up a few years back to start reading the treaty as to which clause applies. The MLI sits on top of the treaty. So you read the MLI and you determine whether MLI amends a treaty. If it does, then you no longer read the treaty by itself. You have to see how does the MLI amend the treaty in question. If the MLI doesn't amend the treaty, you move on. There's nothing to do, you read the old treaty, like US. India-US treaty is not disturbed by the MLI because US has not signed MLI. After this, you really see which clauses of the MLI apply to which treaty. So India has signed clauses, and you will see that, and then you will decide whether Article 5 applies, Article 3 applies, or it does not. That's where you will decide which treaty is amended by which article. This is a subject by itself. I have done 2 hours, 3 hour sessions purely on MLI. So I'm just giving you a primer as to how to see. I unfortunately will not be able to go into examples of which treaty, which clause, how it applies, but this is something that has to be seen in each cases. So like I said, the MLI sits alongside the treaty. So the treaty by itself is not standalone, nor is the MLI by itself standalone. You see the MLI, you see the treaty, and you know which clause of the treaty is amended. The better way to do this is the OECD today gives you a toolkit where you can go on the website. Happy to circulate the link after the session is over, which can be sent to the participants, which gives that link where you can go and select the 2 countries that you are wanting to see. And the OECD today gives a synthesized text, which is the treaty as amended by the MLI is provided by the OECD. Now, unfortunately for us, and fortunately for the regulators, this is not a static thing. So you can't print all of the MLI amended treaties and keep it in a book, because every time a country changes some of the clause, signs something else in the MLI, changes some of the reservations, changes some of the article, the MLI read with the treaty changes. So it is not static, it is dynamic. Countries can choose to opt different things. Mauritius just did something to amend only 2 clauses, but not using the MLI, but direct. But there are countries which have changed the MLI options after they've signed it. So this does not preclude bilateral treaty amendments that can go on, and countries can even decide to amend treaties. countries may create consolidated text. OECD's online matching tool, like I said, is available. On the OECD tool, on website, I personally, this has been very good. I have not found anything which is inconsistent until now. You do just log on to the OECD website, choose the countries, choose the treaty, and you will get a amended treaty. So, like I said, you verify. Just to recap the steps, you first see if MLI is there and MLI is entered into force. You see if both the countries are covered by each country, and then you identify which are the MLI provisions which apply and what clause of the treaty gets amended. So these are the relevant articles of the MLI, which is one, for example, Article 3 talks of fiscally transparent entities, not really too relevant for India. Dual resident entities is an important aspect. So there were always situations where somebody could become a resident of two countries or more countries, or not a resident of either countries, and then therefore income could be stateless, entities could become stateless, and that was used to plan taxes. The MLI introduces a concept where if somebody is resident of two countries, then the two authorities, the two governments can decide as to who will tax and they will become resident of which. Therefore, you will not have a situation of dual resident. That's one example there. Commissionerate agent and similar arrangements. I've told you Article 12, which you see on the next box, which is if you have an agent and you were claiming a position that the agent does not have the authority, therefore no permanent establishment, MLI changes that. Article 14 and 15 are splitting up of contracts. So the MLI has an article which says that if somebody has artificially split up an existing contract and tried to get out of taxation, then you will treat it as one. So if India has opted for that, Germany has opted for that, you can't today read splitting up of contracts differently, just as an example. Same thing on prevention of treaty abuse. These are provisions which talk of the objects of the treaty. And if the treaty says you cannot use the treaty for shopping, you cannot use the treaty for abuse, you cannot as a third state resident access a treaty and get a beneficial rate and use the treaty only for that purpose, you will not be able to do that. And if any country has opted for this, then the famous Mauritius example will not work. Now, Mauritius has not opted, therefore we don't need to go to that. But if there is a country where somebody is setting up a company only to get a better rate, and 2008, 9, 10, peak of real estate, lot of foreign investments, foreign real estate funds invested in assets in India. I was involved in multiple structures where debt came in from Cyprus because the India-Cypriot treaty gave a tax rate of 10%. Therefore, a lot of the companies, what did they do? They had to subscribe for CCDs or debentures where debt had to come. You may be from whichever country, set up a company in Cyprus, fund that company subscribe for debt in the Indian company. The Indian company pays interest, gets a deduction at 34%, which was the tax rate at that time. The Cypriot company pays only 10% tax. So forget reducing the tax, you were getting a 24% tax benefit because you were getting a deduction at 34% and you were paying tax at 10. So all those structures which were put in place only to get treaty benefits go away once the MLI comes in. You cannot access a treaty only for the purpose of getting benefit. That's as simply and as, in fewer words that I can put what the whole of Action 6, the box in red that you see there, does. Which is, if you have gains from alienation of shares, etc., how do you deal with that? Anti-abuse rules for a permanent establishment in a third jurisdiction. All of those are covered there. Where is this important for us today as either practitioners or people who are taking decisions on behalf of companies, corporates? I think the most important is really where you're looking at withholding tax. So it's one thing to look at structures which are amongst the group, which are done for planning. The other is today, if you're making payments to foreign companies, how do you look at MLI? Because the obligation to withhold the right amount of taxes is on the payer. And if the payer does not withhold the right amount of taxes, the government can come after them for the taxes, plus there could be disallowances of the expenses. So the implications are high. Therefore, if MLI is to be considered, is one view to say that the withholding tax obligation under 195 is linked to the taxability. Therefore, if you don't consider the MLI, there could be consequences. Can a company today argue that I will not consider the changes of MLI because I don't have the ability to know whether somebody is put in this structure for abuse or not? I don't have the ability to know if there is substance in another country or not. The non-resident payer, or the payee, the recipient can also is liable. The government has the powers to go after that company. So therefore, why should a vicarious liability be put on me as a payer? And why should I look at and sit and do the work an income tax officer is supposed to do, which is see whether there is substance, see whether there is anti-abuse, see whether a structure is put in place to avoid treaty, etc. I don't think I can give a right answer as to which box you have to choose. These are situations that you need to take a call in terms of the risk appetite. If there is enough for you to see that there's no substance, you're actually working with a US group, but you get an invoice from a Hong Kong company and the US group says this is a company that is part of my group and therefore pay here, is a place where you could possibly ask questions as to why is it coming from some other country where I am dealing with a larger group which is in US. I'm just taking an example. And if basic due diligence is not done, there could be issues. What have we done and what's been my advice to the clients that I'm working with is to at least have basic documentation, take declarations from the foreign parties to say that there is substance, this is what I'm doing, and if there's any issue in terms of this, either indemnification, which is a good option, but not many could agree. But at least you have done the basic work. Tomorrow, if the tax office asks to say that I have taken declarations, I at least have done the basic work that I need to do. Some due diligence has been applied by me before I made this payment, is an important aspect, important thing that needs to be changed in the process that probably has been followed when it comes to application of MLI. So like I said, I wish this sort of, if it was a separate session on MLI itself, there's enough to discuss. There are case studies, there are things that you could have gone into each clause of the MLI, how it applies. I've given a primer because it is extremely important for you when you're considering tax planning at this point. So just as a 30-second recap on MLI, you cannot read treaties standalone anymore. Please do look at what applies, which clause of the MLI, read that and read the amended treaty. Do have access to the OECD website where you will know what the new treaty is, whether it is for determining taxability of a foreign company as a foreign company, or when an Indian company is making the payment, MLI is important. When you're looking at structures, when you're looking at transfer pricing models, involving related parties, involving foreign companies, please bear in mind that MLI needs to be seen. Similar thing which has changed international tax significantly. And I think if I have to get into the third aspect, we looked at how the whole landscape and morality has changed, how law, which is MLI, has changed. The third thing, and equally important, again a legal part that has changed, is GAAR. And GAAR is not something that is only in India, only impacts international transactions or international taxation, but impacts every structure that we are looking at. But there's an interplay with the principal purpose test. And that's what I wish to cover over the next 15-20 minutes. GAAR, as most of you would know, and that's something that you would have probably covered in domestic tax updates and things like that, but I will just touch upon this, is something that applies when an arrangement is entered into with the main purpose of obtaining a tax benefit, where you are doing something only to obtain a tax benefit, which is a defined term, then general anti-avoidance rules or the general anti-avoidance provisions can be invoked. The Indian authorities have the power under the Income Tax Act to deem such a transaction as an impermissible avoidance arrangement. Once something is treated as an impermissible avoidance arrangement, the consequences follow. The income tax authorities have significant powers to either recharacterize income, disregard entities, disregard structures, deny treaty benefits, or any of these things. So if I were to again go back to the Cyprus example that I took a few minutes back. If we were to do that and GAAR was to be invoked, the income tax officer can ask you, what is the purpose that you set up this Cypriot company? Why did you invest through a Cyprus company when you were a US company and you wanted to invest in India and you could have directly invested? Can happen even with Mauritius. If the company were to answer anything other than tax being there, possibly there's a case. But if they say the only reason I came through Cyprus is because I was getting a tax benefit, or the main reason was that there are no people, there's nothing in Cyprus, Cyprus is not a known country for any of these kind of financial activities and things like that. But if the main purpose is only tax, then the tax authority can today say, I will disregard Cyprus. I will disregard this whole structure, which means I will treat as if US invested directly. For all purposes, the Cyprus entity vanishes out of the structure. Or they can say, I will deny the treaty benefits. This is what GAAR can do. So GAAR can disregard a lot of things. In one of the cases that I am involved in, GAAR is being proposed for something as simple as getting a 54F exemption for residential house. To say, why did you invest? Is it only because of 54F, or is there another reason? And I'll come to why this example is important, and please make no conclusions on the 54F example. There are some safeguards which are provided, which is if the tax benefit is less than 3 crores, GAAR can't be applied under the Indian domestic law. There is a limited grandfathering for transfer or income that you get from transfer for pre-2017 investments. So if you've come in through a structure, you've used Mauritius, investments have happened before 2017, today GAAR can't be invoked on that. Then they've also instituted a panel which needs to approve a case where an assessing officer is planning to invoke GAAR. GAAR, yes, has been relied upon in the past. They have also started looking at GAAR currently. The second last point you see on the screen, which is the recent decision of Telangana High Court, is extremely important. What does it do and why is it important? Is if we go back to the same 54F example that I took, can GAAR be invoked there? And this is not an India issue, but GAAR is there in multiple other countries. It's there in South Africa, it's there in Australia, it's there in a lot of other countries, and there's enough jurisprudence, there's enough discussion on when can GAAR be invoked, etc. The primary question here is when there is a specific anti-avoidance rule, can a general anti-avoidance rule be invoked? So what's a specific anti-avoidance rule? Take the example of your old ATIA, ATIC, 10A, 10B, 10AA, all the income tax exemptions that were there. If you were to focus on 10AA or 10A, which is STPI units, SEZ units, or 10B, EOU units, you always had a specific anti-avoidance rules which said the unit can't be formed by a business already in existence or by splitting up or reconstruction of a business which is there. So therefore, the law said that you will get a tax holiday, but if you are running a business, you can't just shift all those people, shift all the plant, shift all the machinery into a different place, register a EOU and claim tax benefits. Because they said this was for new businesses, therefore we have a specific anti-avoidance rule to say if you do any reconstruction, you will not get the tax holiday. There was similar, there are multiple other specific anti-avoidance rules. So the question was, where there's a specific anti-avoidance rule, and I have crossed the threshold, can you then today apply a general anti-avoidance rule? So let's assume there's a pharma company which wanted to expand, they went to Himachal Pradesh, set up a unit, you got a tax holiday. The law said you can't split up, you can't create old business, so you set up a new business, the law permitted that, and now can they come and say the only reason you went to Himachal is because of getting a tax holiday, therefore I'll deny it. There is no other reason for you to be going to Himachal Pradesh, therefore I'll deny. This has been an issue globally. There was a committee set up by the CBDT to examine some of the aspects of GAAR, which was led by Dr. Pachachri Shom. Shom committee said where there's a SAR or a specific anti-avoidance rule, GAAR cannot be invoked. Because you already have a specific anti-avoidance and the government has the ability to pull back cases which which are abusing tax law, and therefore you don't need a general anti-avoidance rule. There's something similar that happened in the Telangana High Court case. Will not get into too much of a detail. I'm sure all of you here understand what they really did was they did a dividend stripping. So they sold, they did a dividend, they did a bonus stripping, not dividend stripping. Did a bonus stripping, which is they issued bonus shares, and then they after went and sold the original shares at a loss and used that loss to set off against other gains that were there, very simply put. Bonus stripping is covered by a specific anti-avoidance rule in 94.7 or 94.8, which says that you can't get that loss and you can't set it off. So the taxpayer actually said that there's a specific anti-avoidance rule, and therefore, you can't invoke GAAR here. Interestingly, the Telangana High Court in the writ has said GAAR can be invoked where there's a specific anti-avoidance rule. So in this case, they've actually held the entire arrangement to be an impermissible avoidance arrangement. They've said you cannot set off this loss, and the government, and the department invoking GAAR is in order, and they can proceed further. Now, this does disturb quite a bit, not just on domestic tax, but also on international taxes, because there is a specific anti-avoidance rule even in some of the international tax aspects, like you could have interest deductions that's there on thin capitalization, which is if you get more debt than what you should from a related party and you are paying interest, your interest deduction gets limited. Even if you have complied with the thin capitalization rules in transfer pricing, can they today invoke GAAR to say, there is no reason for you to have funded this as debt, only for getting an interest benefit, therefore I will treat the debt as equity. Technically under GAAR it can be done, and today after Telangana High Court, I think the department has got a shot in the arm to say that even where there's a specific anti-avoidance, GAAR can be invoked. This, while not directly on the subject on international tax, I thought it's important to discuss because this is just a development in the last 1 week. The more important thing here is on the interplay between GAAR and PPT. So I'll tell you what PPT is. PPT is something that's there in the treaty, and it's come in because of the MLI. So earlier, the treaty always had a preamble which said that we are entering into this treaty for promoting investments, for avoiding double taxation, very simply put. So if somebody were to argue that you did this only to get a benefit, a company could turn around and say, a treaty is there to avoid double taxation, and I have complied with the treaty. What I have done is in accordance with the objects of the treaty. Therefore, what is the problem? So, which is the reason the MLI, the first thing it does is it goes and amends the preamble of the treaty. So you see the title and preamble here in box number 1. The MLI and BEPS require all treaties to have a clear statement in the preamble of the treaty to say that treaty is also signed because the countries intend to avoid creating opportunities for non-taxation, tax avoidance, or treaty shopping. So while the treaty is entered into to avoid double taxation, the treaty today is also entered into to avoid double non-taxation. So you can't use a treaty to get out of tax in both the countries, because the treaty preamble is today amended to say the treaty is intended to avoid creation of opportunities for non-taxation or tax avoidance or treaty shopping. The MLI mandates inclusion of this as a minimum standard. So all the countries which have signed MLI, today this comes in. So what does that do? Look at box 2, which is the PPT, which is the principal purpose test. The clause says if one of the principal purpose of the arrangement is to obtain treaty benefits, then the benefit should be denied. It has to be only one of the principal purpose. It need not be the only purpose. It need not be the main purpose. It need not be the principal purpose. It has to be one of the principal purpose. So if one of the principal purpose, going back again to the Cyprus example that I've been taking, if one of the purpose is you came through Cyprus because I wanted to obtain a treaty benefit, together with some other benefits, which is my senior person was in Cyprus, I had a business there, doesn't matter. If one of your principal purpose is to obtain a treaty benefit, then the benefit should be denied. Then the MLI also proposes what's called a LOB, a limitation of benefit clause. It is an anti-avoidance rule which says that in certain situations, I'll limit the benefit available to the treaty. Where is a LOB there today already in a bilateral negotiation? Look at the India-Singapore Treaty. India-Singapore Treaty, as it stands today, even before the MLI, the standalone treaty has a clause which says that if a Singapore entity, because Singapore entity also, if they sell shares in India, are not taxable in India, Singapore does not tax capital gains tax, therefore, on gains arising from sale of shares, a Singapore resident does not pay tax in India nor in Singapore. The Singapore Treaty today says if the company in Singapore, which is invested in India, incurs less than 200,000 Singapore dollars in a year, then the treaty benefits will be denied. Which really means you can't just set up a shell entity with no expenses, with no operations, and claim the treaty benefits. This is a good example of a LOB. What the MLI today says is that it gives the option to countries to do one of three things. You have to have the PPT only, which is minimum PPT has to be there. Therefore, you amended the preamble. Today, somebody can't say that I am taking benefits in accordance with the objects of the treaty. No, the objects of the treaty deny treaty shopping. Therefore, the principal purpose test is minimum, which will be there. You will have a principal purpose and a LOB, either a SLOB, which is a simplified LOB, or a detailed LOB, or you can just have a detailed LOB. Only these are the options. Therefore, today, it is very clear that post-MLI, treaty shopping using jurisdictions, analyzing which jurisdiction offers low tax, therefore coming from there, is a thing of the past. That's not something that we can today start our international tax planning with in any part of the globe. It has nothing to do with India, but that's what the MLI does. This is the clause of the principal purpose test. Notwithstanding any provisions of a covered tax arrangement, agreement, which really means this clause overrides the entire DTA, because a covered tax agreement is the double tax avoidance agreement. A benefit under the covered tax agreement shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining the benefit was one of the principal purpose of any arrangement or transaction that resulted directly or indirectly in that benefit. So the moment you have a principal purpose, which is to obtain a tax benefit, you've lost the benefit that you are getting from the treaty. Now, unless, and this is where the preamble comes in, the clause says unless it is established that granting that benefit in these circumstances would be in accordance with the objects and purpose of the treaty. Therefore, if it is in accordance with the objects of the treaty, you can still get it. Because sometimes, even in the past, why was the India-Mauritius treaty entered into the way it was? It was for a particular reason. It's bilateral negotiations. You had an agreement with Mauritius for whatever reason. You could enter into lower tax with certain countries on fees for technical services, for example, because you believed a lot of technology transfer would happen. So there could be certain things which is in accordance with the treaty or objects of the treaty. So when you went and amended the objects itself to say that you can't do treaty shopping, then no structure can be in accordance with the objects of the treaty, because the objects of the treaty now prohibit treaty shopping. So which is where the PPT becomes extremely important. What is India's position? India has today accepted, while signing the MLI, to apply PPT as an interim measure. So in all cases, principal purpose test is something that you have to examine. You need to examine whether the principal purpose test is met, not met, what happens. Because all the MLIs that India has signed with any covered tax country, PPT comes in. And they've also said, thereafter, we intend to adopt a limit, the LOB provision in addition or in replacement of PPT through bilateral negotiation. So I could negotiate bilaterally with the country and say, in addition to PPT, please also let us include LOB. GAAR has come in. GAAR also says that if your main purpose is tax avoidance, you will not get treaty benefit, can be disregarded, structures can be disregarded. Therefore, there's a very clear overlap of the two. Today, if you're looking at a structure, if you're looking at a foreign company, would you look at PPT or would you look at GAAR? And how do you align the two, and which do you see first or which do you see next, etc., that becomes important. Because there are also important judicial precedents that are there in Indian context. McToll is known, I don't need to tell you that. Azadi Bachao is important. Azadi Bachao said as long as you have a TRC, you will get Mauritius treaty benefits. You don't need to establish anything else. Vodafone, Supreme Court said what it said, that if the structure has been in place for X number of years, this is not a structure put in place only for tax avoidance. You have a tax residency certificate, you will get the treaty benefits. Would those stand? According to me, none of those stand as good law today because of what amendments have happened. How do you look at domestic GAAR versus PPT? I think the most important is for us to know the difference. Just look at when domestic GAAR applies. It is when the main purpose is tax benefit and one of the tainted element test is satisfied. A PPT applies where one of the principal purpose is tax benefit and is not in accordance with the objects or purpose of the treaty. Consequences, PPT consequence is only one. You will not get access to the treaty. There's no other thing. So either you are in the treaty or you are out of the treaty. There's no other consequence. GAAR has severe consequences. They can deny the treaty benefits. They can re-characterize the transaction. They can reallocate the income. They can treat debt as equity, equity as debt, interest income as dividend. They can do any of those things in a GAAR. The primary onus is on the tax authority in GAAR, whereas in PPT, the primary onus do on tax authority. There is a carve out to say that if you are able to say that it is in accordance with this provision, you will still get out. In GAAR, there's no such thing. Once they have established the main purpose is this, you get out. In a PPT, the focus is only on the actual transaction. In GAAR, the counterfactual, which is, had you not done this or why did you not do this, is a good point that the department is using and can use. On GAAR, the most startling thing that I have personally faced is that one of the tax officers, and this is an order that's been passed, and not under GAAR, but under normal provisions, and I will tell you why in a minute. The tax officer actually was looking at a payment of certain corporate cross charges being paid to a foreign company, and his initial discussion was on whether this amounts to fees for technical services and therefore would the Indian company or should the Indian company be withholding tax at 10%, etc. Now, the moment he realized that there was a 10% withholding already done and the payments were made, he came up with an argument which does not seem silly at the first blush. His argument was that the Indian company is, say, making 100 crores profit, and today you're paying 30 crores of that as fees for technical services and deducting tax at 10%. Show me why the foreign company should have got this 30 crores. Because I believe that this 30 crores, there is no service they have rendered, there's no benefit Indian company has got. You've just made the payment, and because you paid 10% tax, I don't think you'll get a cover, because I believe it otherwise would have gone out as dividend. And this payment is nothing but a form of dividend that you've given to them. Because had you not given this 30 crores to them, they are your parent, the entire 100 crores profit post-tax belonged to them, and they would have got it as dividend and the tax would have been higher. This was during DDT days, therefore the Indian company had to pay DDT. Equally applies even today. You look at a US or a Singapore, the dividend tax rate is higher than FTS, etc. Especially if you say that make available, therefore not taxable. Indian company gets a deduction, foreign company doesn't pay tax, whereas if it is a dividend, they would have paid tax. So he did not invoke GAAR, but what he did was he said, from a transfer pricing perspective, I will treat the arm's length price of this transaction as nil. Because there's no benefit, there's no service that according to me the foreign company has rendered. Therefore, what you've paid, I will treat it as nil. It effectively became taxable in the Indian company's hands. Now, why am I taking this example today is because imagine if this was to be done in GAAR, the tax officer could have actually treated the 30 crores as dividend. He could have said, I will recharacterize this fees as dividend because I believe you would have done this. Where is the counterfactual coming? He could have said, I believe this is dividend, explain why it should not be dividend. And it is a counterfactual argument. He will say, why did you pay this? I believe it should not have been paid. So you are not proving what you have done, but you are actually proving why you didn't do something you should have done, which according to him was there. in GAAR, and I have had one case of a approving panel experience, the department is not, thankfully at this point, carpet bombing, invoking this in every place, only because of this administrative safeguard that is there. Because currently what the department needs to do is they can't invoke GAAR and they can't pass an order immediately. They need to send it to an approving panel, and there's a process that's there, which is not there in treaty. So if a tax officer was to apply and read PPT and say, I'll deny treaty benefits on a principal purpose test, he need not go to the approving panel because it's not under GAAR. That's one of the fundamental difference between the two that needs to be remembered while you're practically handling these matters. There is no threshold in PPT. Like we discussed, there's a 3 crore threshold in GAAR. There is no grandfathering in PPT. There is a grandfathering for investments which are made prior to 1/4/2017 in GAAR. These are sort of the fundamental differences between the two. You need to remember both, because in some cases you need to test both to ensure that when you're planning today, you're not falling foul either of GAAR or of PPT. Because the threshold in GAAR is not as stringent as PPT, and the consequences can be very stringent. Therefore, the second aspect after MLI that all of us need to be aware of is GAAR and PPT. The third, and I'll run through this a little, fast, because this is the importance of the TRC that all of us may be seeing, and the 10F and electronic filing of the 10F that we've sort of started now. This is another thing which has really changed a lot of the way cross-border transactions, intra-group company transactions between two group entities that were planned, structured, etc. has become important, has changed. Because right now, the availability of treaty benefits being linked to a TRC being available has become extremely critical. We have a recent advance ruling which has denied treaty benefits to a Mauritius entity despite there being a TRC. This was at least an accepted position, both because of Circular 786 being there, Azadi Bachao decision of the Supreme Court being there, being blessed by Supreme Court Vodafone ruling. We were clear that at least insofar as Mauritius is concerned, if you have a TRC, that is sufficient for you to get a tax benefit. Today, that is being questioned. The tax department has been very frequently these days countering that view and has been checking whether TRC is there, not there, valid, not valid. The Delhi High Court in Blackstone, again, upheld the sanctity of TRC, but this is now before the Supreme Court, where we will be on this. We'll know soon. This is being argued. This is an important thing that we need to keep our eyes on, because whether a TRC is sufficient proof of there being residency is something that is open at this point. Because right now, there are a lot of aspects on which treaty benefits can be denied, whether we look at GAAR or PPT, and let's stay on GAAR at this point, is because on substance, the income tax department is constantly getting into whether there are tangible assets, employees, office space, and things like that. The old days of same registered office being there for thousands of Mauritius companies. You just set up a Mauritius company, $3,000, somebody acts as a director, somebody gives you a certificate, somebody does audit, there's a bank account. Some of the Mauritius companies I know in the old days didn't even have bank accounts. Those are gone. Today, even if we go for a 197, forget a full-fledged assessment or a 143(2) notice or any other 201 proceedings, etc., even in lower withholding, even in tedious proceedings, we have started getting clear questions about employees, assets, office size, what do you have, what are your meetings held for. We've had questions where they've asked for board meetings, minutes, etc. Again, choice of jurisdiction is being questioned to say why Mauritius, why Cyprus, is there any reason more than this? Decision-making process. We've had situations where I'm personally involved in a case where the income tax department has issued a notice asking us the qualifications of the directors in Mauritius to say whether they're actually equipped to take decisions on investments or not. and what do they do, what is their qualification, what is their profession at this point, where are they, etc. And therefore, what decisions did they take, on what basis the board meeting was conducted, and things like that. Again, substance over form has clearly become important. That's really the most important thing in this third aspect I wanted to discuss. Whether we call it, the spirit versus the letter of law, or you call it substance over form, I think we are in a place where there's clearly more importance for substance than form. So when you're advising clients today, or when you are taking these decisions, documenting some of these, having this in the board meeting, why did you do a particular jurisdiction, why a particular country, even if you have not done it for tax, becomes important, because a presumption is you've done it for tax. And therefore, the onus is on you to prove that you didn't do it for tax. So recording some of these, and my experience, having documents, having minutes which were prepared when the transaction happened is probably 10 times more worth than something that can be produced at the time of assessment. Therefore, today when you are thinking, when you are in the boardroom, when you are the CFO, when you are the tax head, or when you are a consultant, having these things captured, having these factors addressed while you are doing the transaction becomes extremely important. So when you are looking at even withholding or anything, that does that treaty or that jurisdiction have a anti-avoidance registration? Are these already part of the treaty? Become extremely important for you to see, because you can get caught in GAAR either of the places, or in the chain any of the countries if you are structuring your investments. MLI I've covered, whether MLI is covered or not. All of these become important. So TRC, substance over form, not to rely only on a tax residency certificate is the aspect. The last one, not sure how much time I have, but 10 minutes. So I'll rush through this because this is again important. There are two aspects that the global rules are changing. And one is the pillar 1 and the other is pillar 2. And I will not look at pillar 1 because pillar 1 is more on digital taxation and how do you attribute taxes for the Amazons of the world or people who are in country without participating. Very simply put, pillar 1 says the nexus for taxation should not be physical presence like it was in permanent establishment days, but it can be market access and it can be revenue. So therefore, if you have revenue in a particular country, whether you have a presence or not, you will get a right to tax. That's as simple as that for pillar 1. Pillar 2 is important from a tax planning perspective, and that's the reason I'm covering this, is it is aimed at ensuring that a group pays a minimum level of tax regardless of where they are headquartered or where they operate. There was a discussion as to what this minimum rate has to be. Globally, they have agreed at 15% at this point, and somewhere the whole thing is they are wanting to include more and more companies. Right now, the minimum rate is 15%, and then they are looking at companies which cross 750 million euros at a gross consolidated group level. How do you look at this? And I will put it in a headline, probably in a very simple manner, may not sound right read by itself, is that if a company is paying anything less than 15% at a global level, they will at least end up paying 15%. That's what Pillar 2 does. How it does is quite complex. There are multiple tools, but eventually the objective is that at a group consolidated level, you will end up paying at least 15% tax. So you structure your arrangements in such a way that you park profits elsewhere, you have not taxed them, but once you consolidate, you end up paying 15%. What have they done? There are 4 things. Again, hate to be repeating this, but this is a subject by itself. Can be a half-a-day session only on Pillar 2 or probably even a one-day session on just Pillar 2, but these are 4 things which you need to be aware of at a very high level. They have brought in one of these. In some cases, both apply. In some cases, if one doesn't apply, the other applies like a backstop. But the first one is an income inclusion rule, which is it requires a parent entity to pay up a top-up tax on its proportionate share of group entity located in a low-tax jurisdiction. Countries are free to apply the IIR in their country, even if they don't meet the threshold. So what does the IIR do? Very simply put, there's a company, let's just take US as an example. US has a company which has profits of $100, and some of those profits are in Ireland, Ireland chooses not to tax or taxes at 8%, US can collect the balance 7%. US can include the income of that company into their taxation and collect it. So what has this done? This they believed it will do, and it has actually started working that way, that there's no incentive for anybody to be a low tax jurisdiction anymore. Because if you are a low tax jurisdiction and an MNC comes into your country to save tax, they'll anyway end up paying elsewhere. They'll anyway end up paying in their headquarters. Therefore, companies are moving their taxes up. And this is one of the reasons why UAE has introduced a corporate tax of 9% today. Because if UAE doesn't collect that 9%, anyway the MNC is going to pay 9% somewhere else. So therefore, this is the income inclusion rule. I'm absolutely oversimplifying it, but this is what this does. Now, what is happening is this is pushing countries to be a little innovative. To say, can I give tax benefits in a different manner? Do read up on this. Switzerland is one of the early countries which has started doing this. They have started giving benefits on property tax. They have started giving benefits on electricity. They have started giving benefits on land subsidy and things like that. To say that come and operate here, I'll not reduce your corporate tax, because if I do that, it won't give you the benefit, but I'll give you something else other than corporate tax. Because what BEPS and Pillar 2 covers is only tax, and there's a definition for tax, what that is. Possibly, I don't know, but we've had issues where if our manufacturing rate was below 15%, even we would have got hit, because if a US company set up a manufacturing operations in India and had a tax benefit like in the old days, EOU, SEZ, etc., they would have had to pay tax elsewhere, and that's where the PLI is making sense, because PLI is not a tax and they're still getting benefits for manufacturing in India. But something like that. But there will not be, any more of these low tax jurisdictions which will be giving the benefit, because in any case, the companies will go and pay tax in another country. The second is the undertax payment rule, which is applicable where IIR doesn't apply. So what this does is the deduction which is in a low tax jurisdiction goes away, because it's an undertax payment and you end up paying tax. Because the payment made by a company to an entity in a low tax jurisdiction is what deductibility will get questioned. And IIR will have priority over UTPR, because in IIR what happens is you get the revenue. You as a country, which is on top of a low tax jurisdiction, can collect the tax. Again, switchover, subject to tax rules are things which are complex, which are only in a very specific situation that applies, where you are having, for example, the payment in a particular country is only a 5%, and then you can levy an additional withholding to recover that percent to get to what you have to be. Because let's assume a payment that was being done was subject to withholding only at 5%. Today you have a 5% withholding. On top of it, you apply a higher withholding so that you at least meet the minimum threshold, else somebody else will collect the tax on the other thing. So on this, they have brought in at this point a 9% rate. So if some countries have 5% withholding, there's an added 4% that can be there. Why am I running through some of this? Because some of these are not yet implemented. These are plans. These are where countries have to implement. Some have started. India has not started. None of the things India has started. There was expectation that there will be some amendments in the last budget. Didn't happen. Will it happen now in the next month that's there? My personal view, no, I don't think we are ready. And all the countries have committed that if they bring in Pillar 1, Pillar 2, they'll roll back unilateral levies that they have put, which means we have to roll back our equalization levy. So therefore, it may not happen. I don't think our authorities are still ready on implementation. There are plans for implementation also, which has been provided by OECD on this. The last one is where I have just put, if there is a ETR of 10%, then you can do a top-up of 5% because the global minimum is 15%. If the ETR is 18%, then you don't do anything because you are already above 15% rate. If your effective tax in that country is only 12%, then you can collect that 3% because you need to get to 15%. That's what is the rate agreed by everybody. What is interesting here is the level at which you will test this 15% is at the country level, not entity. So if country A in this example, the MNC has 3-4 subsidiaries, 3-4 presence, 1 PE, 1 subsidiary, etc., you will merge all of it. And you will see at that country level, what is your income, what is your profit, what is your tax, therefore what is your effective tax rate, which is the formula on top, which is the amount of covered taxes. In some cases, some of the dividend distribution tax and other taxes are included. But you will take all that, divide it by the income, and you will see whether you are at 15% or not at a country level. If at a country level you are not at 15%, then you today will end up paying that. In this example, at a country A, you are only at 10, you will end up paying 5. Now, if IIR is imposed, you will end up paying it at the global parent level. If a UTPR is introduced, you may end up paying elsewhere. But eventually, you will end up paying that 5% at some point or the other. This is what the whole pillar 2 does. How do you do it? You will see all the entities within a group once you are a covered group. That is, you've crossed that 750 million euros. You will determine income for each of those entity, determine the taxes for each of those, and you will calculate effective tax rate of all entities in that jurisdiction. Therefore, if 5 entities are there, you will compute all of it, you will do this, and you will see whether 15% is hit, not hit, and then you will decide whether the current rules in that country impose income inclusion or under tax payment rule, and therefore you will determine what the thing is. How is this being introduced? There is proposal is to have a global return with line-wise for everything, collected in one place, distribute. All of those have to be still put in place. There's a lot of discussion happening. But finally, once you are in a covered group, a lot of this data, a lot of what you're doing becomes important. Why did I cover this as a part of international tax planning? Because today you can't standalone plan anything and reduce tax. You will end up paying somewhere else because of the global minimum tax. If you plan and you say that there is some FTS royalty structures that can be put in place which was there in the past or anything else to say that there is a saving, I don't think today your international tax structure saving can be seen standalone at an entity level. You really need to see where you will fit in the global thing, whether Pillar 2 applies or not. That becomes extremely important. Now, a lot of these are still, like I said, is in works. The first reporting year is likely to be this year. 26 is when a lot of the things are planning to be implemented. Whether it will happen, not happen, what US will do, what happens in US elections is to be seen. None of this today is applicable, at least in India. There are some countries where it has started, but in India, it's still, nothing is amended. That's the reason I've sort of rushed through this in the last 5-10 minutes. Important for us to bear this in mind. And each of the situation, we need to do a lot more reading before just using what I have covered today. Latest update I'll just skip because there was even some update yesterday. It's just a few countries are there. We'll circulate this presentation. So I think that's all I had on the 4-5 key aspects which have changed the international tax planning situation and what needs to be borne in mind. Thank you. Thank you so much.
Thank you, sir, for an excellent exposition of your knowledge.